Hey, welcome back to Father and Son Investing. Today's video is the January 2024 Treasury Note and Bond update. I did the Treasury Bills as a separate video earlier this month. If you're interested in Treasury Bills, then go ahead and watch that one as well. You know, my favorite kind of ice cream is Rocky Road, and that is going to be the theme for the month of January when it comes to Treasury Bonds, and actually maybe for the next few months for Treasury Bonds and Notes. Rocky Road, why do I say that? Well, truthfully, I actually borrowed that theme from Schwab in this article in December 2023. They talk about the rocky road ahead. And in fact, they have a pretty apropos cartoon there by Charles Gary. Sorry, Mr. Powell, all we have is Rocky Road. Just what is it that's going to make it so rocky? Well, the Fed is really trying to thread the needle when it comes to keeping inflation under control, keeping jobs from being lost, and helping to sell the treasuries, Treasury Bills, Notes, and Bonds. That is a tough task trying to navigate all three of those. Now, traditionally, we say that the Fed, their mandate is to keep inflation under control and to keep as many people employed as possible. But really, there is a third mandate kind of creeping in there, and that has to do with helping the Treasury sell their debt. Because if interest rates get too low, I think, and a lot of other people think, that the government is going to have a hard time selling their debt. In fact, they've already had a little bit of a hard time selling their debt, even when yields were higher. Back in October and November, they were having some difficulty with some of those auctions, with the numbers being lower, meaning people being less interested in buying government debt. And that's when the yields were higher. So today we're going to talk about three specific things that I think will play the biggest part of this rocky road ahead. The first one has to do with the economic numbers as they come in. Every little economic number that changes just a little bit has some sort of significant effect on the bond market. Let's take a look at what I'm talking about. Here's an article from January 5th in the Wall Street Journal. Hot wage data drives up Treasury yields. Then an article the same day, yields retreat following soft service sector data. Now that difference was just the same day. Talk about a rocky road. Now we're going to have some upcoming economic numbers getting released, particularly this week. On January 11th, the Consumer Price Index, and on January 12th, the Producer Price Index. What is the expectation for the CPI when it comes in? This is from the Cleveland Fed's Inflation Nowcast. We can see that for the month of December, they're predicting month over month to be 0.3%, with the core CPI being 0.33%, and the 12-month year-over-year inflation rate to be 3.32%. Now that's going to be coming in just slightly higher than it did back in October and November, so we're looking at a little bump in inflation here. What do you think that's going to do to bond yields when that comes out? Even though it's expected, what do you think will happen on Thursday to bond yields, just based on the CPI numbers? The second thing I think that's going to make this a rocky road is something that I mentioned earlier, and that has to do with the Treasury's bond auctions. These should just be ho-hum, nobody pays attention to it kind of thing. But lately, people are paying attention to these bond auctions because, as I mentioned, back at the end of 2023, the Treasury was having a little more difficulty getting people to take their debt. So here's an article that appeared just a few hours ago in Barron's, Why This Week's Bond Auctions Have Investors on Edge. So this week there are three bond auctions. The 3-year Treasury note auction actually just took place a little bit ago. I'll show you the results of that here in just a minute. But we also have the 10-year Treasury note auction tomorrow on Wednesday. And then on Thursday, after the CPI numbers come out in the morning, the 30-year Treasury bond auction will conclude. So it'll be interesting to see what happens with that 30-year Treasury bond auction after inflation numbers come in. Now, I'll tell you that the 3-year Treasury auction day was considered strong. What do I mean by that? Well, first of all, they were issuing $52 billion in 3-year Treasury notes. Now, that actually was $2 billion more in Treasury notes than they issued last month. So they were auctioning just a little bit more, but the numbers in terms of interest came in a little bit better. So when it came to the bid to cover ratio, remember, bid to cover just means how much money was being bid for these Treasury bills versus how much they had to sell. So that ratio came in at 2.67 for this Treasury auction. That was ahead of the 2.42 for earlier in December. And when it came to foreign investors interested in this auction, those numbers improved as well. 65% of this auction went to foreign investors versus just 52.1% in December. Now this is for the 3-year Treasury note. Why might this auction go well and the other auctions potentially not as well? In answer to that, take a look at this headline here. The former bond king, Bill Gross, says 10-year Treasury is overvalued. Now, if the Treasury is overvalued, he means that people are paying too much for it, meaning the yield is too low and the price is too high. In fact, further down in this article, he goes on to suggest that people might want to be looking at the 2-year Treasury. He says go long on 2-year Treasuries and short the 10-year Treasury. Now, I'm not suggesting that you short anything here. I think that shorting something can be a very risky strategy. Nevertheless, that's what he suggests. So what I take away from this is that the shorter term Treasury notes, 2-year, 3-year, those auctions might go better than the 10-year and the 30-year. We'll wait and see what happens here. Now, the third reason why I think it might be a rocky road has to do with the Fed and the predicted interest rate cuts this year. If you look through what the Fed has been saying, we're looking at 3 interest rate cuts potentially for 2024. Nevertheless, much of the market is predicting 6 interest rate cuts in 2024. This one here is from Morningstar, but they're not the only ones who are saying 6 interest rate cuts. Just this battle here creates some volatility. The market starts pricing in the bond interest rates or yields ahead of the game. That was part of why interest rates fell so drastically there at the end of 2023, because the market was already starting to price in interest rate cuts. So when it comes to trying to predict what notes and bond yields will be doing during 2024, it actually gets quite difficult. I've seen predictions for the 10-year Treasury note going down to as low as 2.5%. I see a lot of predictions in the 4 to 4.25% range. And I see yields on the 10-year Treasury note even going up to 5.5% being discussed. Why such a wide spread? Well, I think that has to do with what I said earlier when I talked about the Fed cutting rates versus the U.S. Treasury's debt and trying to help the Treasury sell that debt. Now, the Fed has been rolling Treasury notes, bills, and bonds off of its balance sheet. That is helping to drive inflation down. However, if the Fed has to reverse course and stop rolling those Treasury notes, bills, and bonds off its balance sheet, i.e. starts purchasing Treasury bills, notes, and bonds, that is going to be inflationary as it puts more liquidity into the market here. Let me just show you the magnitude of what I'm talking about here. This shows the Treasury bill gross issuance from 2012 up through November of 2023. Look at just how little it was back here in 2012 up to about 2015, and then we just start seeing these spikes. Now in 2020, this might be a little bit more understandable given that initial phase of the pandemic and what was happening. But that is not the case now. In fact, we see from these GDP numbers that the economy is doing quite well, and yet the government is borrowing record sums of money. Now, a lot of this record sum of money has been issued in the form of Treasury bills recently. In fact, last summer, when the Treasury started restocking its coffers, they issued a huge amount of Treasury bills. Now, you may know that Treasury bills are for 12 months or less, which means all of those Treasury bills are going to be coming due, and the government is going to have to issue more debt in order to pay off the old debt. Now, there's a problem here for the Treasury. If they continue issuing more Treasury bills instead of notes and bonds, that suggests that there is some problem with U.S. long-term debt. And that itself is going to create some problems in trying to sell their long-term debt. So the Treasury really needs to start moving towards selling more notes and bonds. In fact, in the past, and really at least at the present time, Treasury notes still make up the bulk of the total U.S. debt. Last August, when the Treasury issued their 3-month plan for issuing the debt, they had a big portion of it being Treasury notes and bonds. And what happened? The yields skyrocketed. So then in October, when they issued their latest quarterly statement, what they did was decrease those and increase the amount of Treasury bills. This is a path that really they just can't stay on long term. So in the next few months, I expect to see more notes and Treasury bonds being issued. And when that happens, I think there's a high likelihood that the yields on those start climbing again. The question will be, what floor are we at by the time those yields start climbing again? And that's going to have to do with when the Fed, if they actually do make rate cuts, when will those come? Now, the market is pricing in the first Fed rate cut in March of this year. However, the odds of that happening have actually come down recently. From the CME Group Fed Watch tool, you'll notice that for this upcoming meeting here at the end of January, 95% chance that they don't make any changes in the rates. However, when it comes to March, this has gone down now to about 63%. Just the other day, it was in the 70s. And earlier in the year, and we're only 9 days into this year, earlier in the year, it was higher than that. So we see that the market is starting to get the idea that the Fed may not be cutting rates anytime soon. In fact, I saw in Kiplinger a suggestion that the Fed might not cut rates until May of this year, having to do with it being an election year and the Fed wanting to make sure that inflation is very under control before they start cutting interest rates, and not making the final potential third interest rate cut for the year until after the November 2024 election. So what is going to be the take-home point for this video? Well, it may be this: lock in higher rates on your bond portfolio while you still can. Now, that may sound counter to what I was just speaking about, whether the yields on notes and bonds may potentially be going up. I think that the yields right now are in such a good spot compared to the last decade that purchasing some bonds and notes can still be to one's advantage. So what if the yields do go up? Well, remember that the returns on bonds come from both the price moving and from the yield returned. So knowing that you might be locking in a 10-year Treasury note at 4%, if it goes up to 5%, the haircut or the loss that you're going to be taking is much less than it was earlier when the Fed started raising rates, going from, say, 0% almost to 1% or even 1% to 2%. However, I also think that not going all in on these current bond yields may also be a wise decision. For instance, here's a projection from the Congressional Budget Office. They say interest rates on long-term Treasury securities are expected to remain elevated through the end of 2024. In fact, their prediction for the fourth quarter anyway, of 2024 is at 4%, which is currently roughly where we're at right now. Here's another prediction from Bank of America. Their analysts are saying for the 10-year U.S. Treasury, 4.25% at the end of 2024. So one can go ahead and lock in some of those rates now, but not going all in, knowing that should yields go up, as I think they should based upon the U.S. Treasury's current fiscal situation and the way that Congress is operating, those numbers say that really yields should be higher than they are right now, in my opinion, and in the opinion of many of the people that I have been reading or listening to. And if those yields don't go up, the predictions at least are predicting yields by the end of the year currently just about where they're sitting right now. In fact, as we wrap up this video, let's just take a quick peek at what has been happening with the 10-year Treasury note yield, and we'll see that currently that's at 4.021%, just about what those predictions are falling in line with, and for Bank of America, predicting a little higher by the end of the year. I hope this information was helpful for you. If it was, please give us a thumbs up. Don't forget to subscribe, and until next time, enjoy your investing.